tax advantage products in the country and serves a nationwide network of financial professionals. Call 1-800-290-7226 or email thequest@brokersalliance.com. And remember, when you need financial guidance, call Brokers Alliance.
Well, welcome back to the Quest for Financial Freedom. I'm your host, Steve Savant. Of course, with me is national insurance expert Eric Palmer. You can call 1-800-290-7226. That's 1-800-290-7226. Or just write us at our email address, thequest@brokersalliance.com. In the second segment of today's show, we're going to talk more on long-term care and a life insurance contract, but this time, instead of deferral, maybe tax-free. Now, we used a little bit of industrial language, which is a bad boy issue on this show, okay? We talked a little bit about a modified endowment contract. Now, that sounds like a very official and very scary term, and it can be from a tax point of view. When we talk about buying single premium contribution into a life contract that has an LTC-linked benefit, that is automatically classified by the IRS as a modified endowment contract. That means that if you surrender the contract and it had any kind of gain, you're going to pay your gain on it first, taxable event, can't do anything about that. But if you kept it in force, you're going to have a tax deferral. And as long as that deferral is being used, those gain deferrals are being used for a long-term care, you're not going to pay any taxes.
That's exactly right. The IRS put some rules into place so that long ago we couldn't just dump a whole bunch of money into life insurance and use it as an investment vehicle. So there are some parameters there, and these large single premium contracts that we've been talking about, they are MEC, M-E-C, modified endowment contracts. And so if you're just making a regular withdrawal because you decided you wanted to catch up on some bills or just pull some cash out, you are going to pay ordinary income tax on that. And again, talk to your tax professional about what that number could be. But if you're using that, especially by triggering these living benefits built into the policy and using that money for long-term care, it is tax-free.
Now, when you buy these contracts in the single deposit arena, you really can't put two lives on one platform, right? You can't, like on some of these other, we'll be talking about this tomorrow, you can on annuity, but on this one you can't.
Right, that's right. But they're single premium contracts on an individual life, and a lot of this are for those individuals that, there's a statistic out there, they say that the large single premium contracts are really for the individuals that, have about $75,000 of annual income or more, because typically they have enough savings on the side to create a pool of money, say $100,000, to put into a contract like this. But what about the individuals that aren't quite there yet, that haven't had the number of years to save up the large pool of money? We have different types of contracts out there, and I think they're notable. There's life insurance contracts that are an ongoing stream of premium. You can pay it monthly, quarterly, annually, and you can add a rider to these to provide things like that chronic illness coverage that we've been talking about, where they accelerate that benefit on a monthly basis for you. So it's a little bit more affordable approach. Maybe you're in your 30s or 40s, you haven't saved up the large sum of money yet. You're listening to the show today. You're curious about, well, how do I get into something like this? You certainly can. There's contracts out there that, again, you pay on a monthly basis, still provides these type of benefits for you.
If you're going to stage it in, you may be able to create a non-modified endowment contract, which means you could access this money free.
That's where I'm going with this. We talked about a lot of different types of life insurance today. We mentioned term insurance. I mentioned permanent, which is more often called a whole life or universal life contract. Last week we talked about indexed annuities. There's also an indexed universal life contract, which essentially is it's a long-term life insurance contract that's tied to an index that allow you potential gains. And these types of contracts are used a lot of times because there's great distribution in the future. You could potentially use it as a supplement to your income at sometime in retirement. So these types of contracts with those built-in living care benefits could be a little bit more beneficial if you're thinking maybe you want to prepare for retirement, have those living benefits available, and you don't want a MEC contract.
And a MEC contract, again, would be a taxable event if you took the money out on gain.
Right.
So if I have these, you're saying, I'm hearing you say that there's indexed universal life contracts that have these long-term care linked benefits to them,
Right.
which you could then say, one, it could be a savings vehicle, but if I need to access this money, I could. If I stage it in instead of paying a single deposit, I might be able to create, again, you need to talk to your tax advisor, but you might be able to create a tax-free, not only death benefit for your beneficiaries, but if you needed access to it yourself.
That's right. If it was not a modified endowment contract and you're funding it over time, you potentially could take distribution tax-free out of it as well, and that could be, again, supplemental income for you in retirement if you decide you don't need the living benefits
And we'll send
anymore.
you any of this information. If you need information on any of the life contracts, there's several out there that carry these long-term care provisions. We'll send you a complete comparison grid as well as a little blurb, a little nice explanation of what a modified endowment contract is and what our non-modified endowment contracts are. So you can look at the taxable issues, discuss it with your accountant, your tax attorney, your advisor, and see if that's a good thing for you. Now, I'm looking at some of these things. Do they have regular, like this long-term care, like I'm thinking of a couple of the big ones that are out there by some of the biggest names in the business. Do they have normal benefit periods, elimination periods, inflation protection?
They do. Some of those, the contracts we mentioned at the beginning, the single premium or flexible premium modified endowment type contracts that have more long-term care type benefits. So there's a pool of money that's created. It's distributed over a set period of time. X amount per month based on some sort of long-term care event. These contracts provide a lot of liquidity, like the return of premium, but they also provide that stream of income on a monthly basis and carry a little bit of a fee with them along the way too. But I think that it's pretty much a wash when you get into the tax-free distribution side of it.
Well, if I was trying to protect, I'm trying to look at, because these benefits, long-term care has its own. I mean, healthcare period is very expensive, and so are these.
And sometimes the benefits don't pay out. I think you're alluding there to the elimination period or the waiting period, if you will. Some of these products say that you have to have the product for a certain number of years. Sometimes it's 2 years. That's kind of a common approach. Some of the products we're talking about, for example, today.
So that you're sick and you don't buy it right before.
Right, you can't go buy it and then go hit the nursing home within a month. So some of them say you have to be in the contract for a set number of years. And then what they also say is there's an elimination or a waiting period, which means if I have my long-term care event today, it might mean that I have to spend my own money for the next 90 days before the benefit inside the contract will pay out. And so that's something that we actually put side by side when we analyze product, because we want to make sure that we're putting our clients in the best position possible.
Because these contracts are all over the board on this issue. So you might have different elimination periods, which you got to kind of wait it through first.
Right.
And have your before you can actually engage. And then once you're cross, maybe 1 year or 2 year, then your elimination period, this waiting period begins, so that you have 90 days out. So really, you need to start looking at 1 or 2 years of money set aside.
Right. And it's not a bad thing. Look at it like a deductible on health insurance policy. You know, there's a little bit of cash you got to come out of pocket up front, and then the rest of the benefits kick in. These long-term care, whether they're standalone or like the linked benefit products that we're talking about today, they could have that waiting period, and you definitely want to read the language and see how long it is before the benefit starts paying out.
You know, there's a lot of debate, and this is a debatable controversy here of using the inflation protection benefits on some of these, because it's an option. You don't have to get it. And I'm always caught left and right. You know, how long am I going to hold it? What kind of rate am I going to use? And then on top of that, I have to figure out, well, is that a good use of the money?
That's right.
You know.
That's right. You know, we just printed off billions and billions and billions with a B in money in the government there, and that's, you know, historically going to create some form of inflation. We're all expecting it to happen over the next 5 to 10 years. So when we're quoting long-term care, whether it's linked benefit within an existing life or annuity contract or a standalone policy, we're going to want to look at that specific feature and find out, again, which is going to be best for the client.
When we're talking about actually triggering an event now that we're taking our benefit, but before we do that, way back when we write this contract, we have to choose between two forms of how we're going to get paid. One is indemnification, and another one's called reimbursement. So reimbursement, you know, what's the yin and yang on that?
And there's actually a third. I'll throw it out there. It's not very common. It is found in some policies, but there is also a disability. Again, that's not found as often. The most common is the reimbursement and the indemnity. What reimbursement says is that this contract will reimburse you for your medical expenses. So you've got to spend your own money first, and the insurance company is going to send you checks. So you got to turn in some receipts. They send you the actual amount in the form of a check after the fact. Indemnity is where once you trigger that long-term care event, you get through your waiting period, the checks just start rolling in. You don't have to turn in receipts. They're not itemizing you based on what your medical expenses are, and that could be beneficial. In fact, we find that that's very popular right now because, again, with the at-home care levels being as high as they are, not all that check is going towards the nurse that may be coming into the home. It could be going to your prescriptions or some of those specialized bathtubs to help you get in. I mean, it just depends on what the expense is.
Well, I'm thinking that if all I have to do is trigger a long-term event, and if my benefits, like let's say as an example, $4,000, but my licensed event is only $1,000, they're still sending me $4,000 whether I use it or not.
That's right.
I mean, I love that. Now, the give up on using the indemnification is you're not going to get the benefit, the monthly benefits. It's higher with reimbursement.
We tend to see a little bit more robust benefits in the reimbursement policies versus the indemnity policies, and that's the exchange you get. So you have to ask again, what kind of care do you want to have if you end up having a long-term care event? Are you going to be taking the at-home care, and do you see yourself in a nursing home?
I've been looking at both, and depending upon the timeline of the client, what our expectations are. So far, and again, I'm not trying to steer our audience or anything, but so far, the math seems to be on the indemnification side, especially when you think these benefits are coming tax-free. And if I put $100,000 in and I was getting a $4,000 benefit tax-free, I don't know. I'm sorry, but I'm going to have to check the municipal bond income indexed here, but I don't know if I can beat that.
And even if you are in a facility, I think the average cost of a facility on a monthly basis is somewhere around $3,200, $3,300 a month. So a $4,000 benefit would cover that cost, and you would have that difference to hang on to again for those other expenses, like maybe prescriptions that you're shelling out on a monthly basis.
Well, I like the idea if I have an event, I have my licensed practitioner come in here, and then I let my children or whoever come in and take care of me. If I have to keep it in the family, if I have to pay it out anyways, wouldn't it be great to do it at home? Have it within the family if I could, and have that, at least have that elected choice to go a way that would really be convenient for me and to really keep the kind of dignity and privacy that I'd want in my own home. I mean, I think that there's some money, that's worth it to me. Remember, when we're looking at indemnification or reimbursement or any of these elimination periods, it's all about value proposition. Is it a good deal? Does it make economic sense? Does the bang for the buck, does it actually work? Does it give me a better deal? And that's what you always have to do. You have to sit down with your advisor and weigh it all out.
Absolutely.
Well, listen, I want to thank you, Eric, for being on our show, our sponsor, Brokers Alliance, and America, where anyone can go on a quest for financial freedom. So until next time, remember what the good Reverend John Wesley once said. Make all you can, save all you can, give all you can. I'm Steve Savant. Join me next time on my quest for financial freedom.
Quest for Financial Freedom is brought to you by Brokers Alliance, the premier provider of guaranteed and tax advantage products to a nationwide network of financial professionals. Need financial guidance? Call Brokers Alliance. You can request an email link of this webcast at our email address, thequest@brokersalliance.com, or call us 1-800-290-7226. That's 800-290-7226. And join Steve Savant next time on the quest for financial freedom in your lifetime.